The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
Good morning, everyone. Welcome to the Investor Resources January market update. First one, obviously, of 2024. A good place to start your investing year off. This morning, we're going to cover quite a bit of market data as usual. Just keep in mind on the way through that these two fellas, fear and greed, those are the two of the primary drivers of the market all the time. And for our purposes, they're also the main cause of people getting off track. Those are the things that are going to scare you out of a good disciplined approach to the market, is fear and greed. And so just let that percolate in the background while you're enjoying the rest of this presentation. Also like to remind everyone, anyone new, the newcomers this morning, if you have any questions that pop up during the presentation, feel free to enter those in the question pane on your on-screen control panel. You can enter those in at any time. We've got a dedicated part of the presentation later on after our prepared portion, and we're going to get to all of the questions that y'all have to ask this morning. Okay, so let's move into our presentation. Where are we now? Where are we going? There's the big questions for January. 2023 was a huge year for stocks after a terrible year for stocks. A handful of huge stocks provided a huge influence to push stock indexes higher in 2023. And then over the last 2 months of the year, there was absolute mania over the Fed saying they were actually going to cut rates in 2024 a number of times. And that not only threw more fuel on the stock market, it also turned around the treasury market and caused the 10-year treasury yield to come right down a mountain. Then it took 2 years. It spent 8 months climbing up, not 2 years. But these huge movements in the stock market, they undid most of the damage that 2022 had done, but not all of it. And more importantly, it was unevenly spread. Not everybody got, everyone got relief, and not everyone got rebound. Indices that were dominated by the largest stocks, including the Magnificent Seven, which we've all talked about at this point, reached new highs. The NASDAQ 100, not the entire NASDAQ, but the NASDAQ 100, the Dow, all hit new highs last year. And despite the huge year for stocks, the Russell 2000, which tracks 2,000 small cap stocks, ended where it had been in January of 2021, 3 years ago. The S&P 500 ended below where it had been 2 years ago, and the NASDAQ as a whole ended where it had been in August of 2021. So with that overview, let's start breaking this down, see where we're at here. S&P 500, that's our favorite index to follow. It was up over 24% in 2023, after being down 19.5% in 2022. At the close, it was just 0.5% below the all-time high of 47.96, which was 2 years ago in 2022. So, oh well, we didn't get to an all-time new high. Maybe this year, it'll come at some point. We don't know. So the years of 2022 and 2023 turned out to be quite a show. We had massive up and downs to end up nearly in the same place we started 2 years earlier. So it's important to take a step back and remember the context of where the markets are, because 2022 felt like this is never going to end on the way down, and 2023 was one of the best years we've ever had. It's so great. Turns out we just went nowhere. It was just a lot of sound and fury, and we didn't make any real progress. And it's important to take a step back, get a little context, and understand what those numbers mean over slightly longer time frames. The NASDAQ composite, 43% gain in 2023, a huge rally, completely reversed the 33% drop in 2022, closed above 15,000, but it was still down by 7% from its all-time high, and that was in November of 2021. The index first reached that level in August of 2021, so after 27 months of rabid volatility, it ended up back in the same place. Again, huge volatility, lots of massive moves up and down, and then a couple of years later, here we are. We're right back in the same place. So we recovered from the drawdown, but we really haven't made any progress for a number of years now. And as I said, that's an important thing to keep in mind. Keep that in your head. Looking at the NASDAQ 100, which tracks just the 100 largest stocks on the NASDAQ, excluding financial firms, it was up by 54% in 2023. So completely erasing its drawdown from 2022, plus a little more. And it started hitting all-time highs in December. And the 54% climb was the best year since the dot-com boom in 1999, which of course was immediately followed by that thing they call the tech bubble bust. And let's don't talk about that this morning. We don't know if that's what's coming up, but that's the last time we had growth that big. And in both cases, a handful of huge stocks powered those rallies, and the mega caps way more heavily in the NASDAQ 100 because there's fewer stocks in the NASDAQ at large, so it has a larger impact on that index. The good old Dow Jones Industrial Average tracks the largest stock in each industry, 30 of them. It was up almost 14% in 2023. And in December, it started hitting all-time highs, closing the year at 37,690, having way more than wiped out its 8.8% decline in 2022. The Dow. It's important to remember the Dow is only 30 stocks, so we get moves like that. It's a little quirky sometimes because there's not a lot. There's not a lot of securities there. But, the S&P 500 is almost 500 securities, so. With only 30 securities, you get movement in the Dow sometimes that doesn't correlate to the rest of the market. It's still important to look at the average, but it's it's nowhere near as tech heavy as it needs to be more representative of the U.S. economy as a whole. But it's slow to change. Sometimes that makes it valuable because it is reliable year to year and what's in it, and sometimes it makes it not too representative of what's actually going on. But 2023, still a very good year for the Dow. Russell 2000, we were talking about that just a moment ago. That tracks the 2,000 small cap stocks into the year below where it had been 3 years ago. That's an amazing number. In 2023, it was up 13.7%, but not enough to make up for the 21.5% it was down in 2022. So it's the same place it was in January 2021. So that is years of going nowhere, and it's down 70% from its all-time high in November of 2021. So again, those 3 years have been an absolutely wild ride. Lots of volatility, and we're not making any progress here. So this is how it can verify for you to not get too hung up in what's even going on this year. You need to take a little step back, get a little broader view, and say, okay, so how are we doing in a little bigger time frame? These charts are all years apiece. So this is already a 40,000 foot view of the market. Sometimes you need to go a little higher to notice that what it's not as bad as it was, and it's not as good as it was either. So we're just kind of muddling through right now and getting hit with all the volatility. So you need to keep that in mind, keep watching that, and look for those consistent trends that begin to build, which you never see coming. They always show up. You identify them after the fact. The Magnificent Seven here, that's been the real story. That's been where all of the real strength has come. And this chart starts back on November 16th. in 2021. The NASDAQ peaked in the middle of November, and so that's where this chart begins. And since then, the stock prices of these 7 enormous stocks, they changed in different directions. NVIDIA on top, 64% gain. Tesla minus 29%, and Amazon and Google both still down for that time frame, which is important to point out that even in the Magnificent Seven, the returns weren't uniform. There were winners and losers. And so there hasn't been an even application of the rebound in 2023, even in the Magnificent Seven stocks, which is surprising to see. But it's all about time frame. It's when are we looking at here? It's definitely not been smooth sailing for any of them. By November of 2002, so just coming into the year, they were all in the red. Everybody was down, all of them. Which is amazing. Meta was down 73%, and Apple here was down. They were the best in holding up in that drawdown, only down 3% at the end. But all 7 of them were in minus territory. And again, that's important to remember that when looking back at some of the huge numbers, which we're about to get to, they all had significant drawdowns. They all were in negative territory. And so that's a natural state of anything you buy. It's something that you really need to kind of just incorporate into your thought process. This is going to happen. Doesn't matter how good things are, you're going to have negative trends in there. It's just a matter of how long you're willing to tolerate those. Prices rose, obviously, and all 7 of those, they exploded way higher. And at the end, NVIDIA, up here at the top, that it spiked 252%, and Meta 207%, Tesla 120%. So there was nice comeback on all of those. Microsoft, with a market cap of pushing 3 trillion, now is up 60%. It's hard to imagine a company that enormous with those kind of gains. And Apple, which is the largest company in the world currently, again right up in that $3 trillion range, it was up 53%. Those 2 companies gained $3 trillion in market cap in 13 months. That is astounding. And they're gigantic market capitalizations. They're massive companies. Combined, those 7 stocks have a market cap of $12 trillion. So when these guys start moving around, it really pushes the indices around in a really big way. That massive surge fueled a rise in the indices that they dominate. That's where the gains came from, by and large. Not completely. The rest of the S&P 500 in particular was up also, but this is where the real growth came from. That's where these were the big drivers, because the companies are so huge, and even at their size, they had massive gains, and that'll move any index around. Okay, how about the 10-year Treasury yield? That was funny too. It ended 2023 at 3.88%, right to the basis point where it had ended in 2022. So again, we have climbed this huge mountain, but over the past 12 months, it's gone nowhere. It took 8 months to climb up here, and then just dropped off the cliff when everybody decided the Fed was going to start cutting rates, and significantly and often. That was the feeling. This has already bounced up a little bit since the end of December, in that there's a little bit of waning of the mania about the Fed and exactly how fast these rate cuts are going to come. The rest of the world tends to come back to reality. But again, this is a case for the bond market, no different than the equities market. We've had a couple of years of just flatlining and lots of volatility. Well, the bond market really hasn't been that different. Had big drawdowns also, and then significant highs that it has not returned to. So it's one of those cases where stocks and bonds are moving together, not opposite, and that's important to keep in mind for your portfolio. So what can we look for here? What's coming up? What might 2024 have in store for us? Um, History suggests an up year, and we know that sounds a little bit like a broken record coming from financial advisors who are always talking about what a great year it's going to be. But that is where the data is leaning right now. For example, this chart, if you look at the distribution of returns in a year following a big up year, so that's this year, last year was a big up year. This year, you can see that generally this line of the graph, you get higher returns than this line, which is all other years, the average of all years together. This is just after a big up year, and this is excess return that shows up. Here's the zero line, so everything over here is to the right-hand side of that. Those are excess returns to the positive side. Usually after a big up year, you get an average of 11% returns compared to 7% in all other years, and that's one of the things that suggests that market momentum is a real thing. We've talked about it many times that returns tend to group, and this is no different. This is what we mean. After a good year, you're probably going to have another good year. Which bodes well for 2024. Of course, it's absolutely no guarantee, but history would suggest we're looking at a good year. Unfortunately, these kinds of trends, they don't last forever, which we talk about often also. That's why we constantly track data, because even if something has been good, it doesn't mean it always will be good. So if you look at the next 5 years following a big up year, all that momentum kind of fades away. As you can see, that these two graphs become almost identical. They're up and down a little bit in different time frames, but it's about the same. So you're going to be over 5 years. There's not a big advantage there. So during those times when you have one, you need to take advantage of it, and then you need to practice, getting out of the way, because as these plots would suggest that up years tend to follow up years, that momentum eventually fades away, and something else is gonna start driving the market. So you always have to pay attention. There's never a time in the market where you can relax. There's never a time where you can say, okay, we're set. This is what we're gonna do. Things are too volatile for that, and that's kind of what our expectation is for 2024, and quite frankly, for most years, barring something really unusual. Markets are going to move up. They tend to trend in upwards most of the time anyway, until some catalyst knocks them off track. In 2008, that was defaulting mortgages, led to the great financial crisis. And 2020, it was COVID-19. Well, it was the response to COVID-19 that really put things in the tank. And then in 2022, it was investors waking up to high valuation and saying, wait a minute, that was a nice huge run up. We're not sure why. And so then it backs off. So the question is, well, what's going to cause the next market decline? And we don't have a clue. We never do. It could be a geopolitical event. There's plenty of that going on right now worldwide. Could be a weather catastrophe, earthquake, tsunami. It could be another supply chain crisis where everything breaks down for some reason. But whatever it is, it's going to be unpredictable ahead of time. If it weren't, the market would have already priced it in. And there's nothing like that on the horizon right now. So that's important to remember, that those big things that really do change the market, no one sees them coming. No one sees them coming. There's no way to get ready for those things. That's why you have to be adaptable in your portfolio management. You have to be ready to make a change, because the market changes without notice. Good news is, markets tend to recover from those declines, and they continue growing after they've been hit. It's not true all the time. There have been some very long runs. Japan, back in 1990 topped out, and they're still trying to break new highs. So you can be flat or down for a long, long time, but it's been true on a global scale for the last century. By and large, that's what happens, and that's what truly matters. That's the part that you should really be looking at. And even though you can find isolated cases where that doesn't hold true, most of the time, that's the case, and that's the best you can do. Put the probabilities on your side, and then keep moving. That's all you can do. The problem with using history even that much as your guide and staying mostly bullish most of the time, we need a reason to not think that the market's going to keep expanding. That never makes you sound very smart or very sophisticated, but sounding smart doesn't mean being right. Those are two different things. And unfortunately, some people would rather look like a mistaken genius than a correct simpleton. And we embrace simple every time we can. That's always the best solution. Most people's problem is failing to realize that that unsophisticated approach is the right approach. That's the way to look at this. You can get lost in the weeds so quickly and even forget why you're doing what you're doing. And that's something you want to avoid at all costs. Nevertheless, there are going to be those that believe that it just can't be that simple. But it really is. It's simple, but it's not easy. It isn't easy to watch stocks fall by 7% in a day, which we've all seen. It isn't easy to see rates rising while inflation is also soaring. That makes things very difficult. It's not easy to witness people getting rich from magic internet money. There are people out there chasing, Bitcoin and non-fungible tokens, and all of a sudden they're rich and you're not. And you're like, am I doing something wrong? And the answer is no, you're not. But that's what makes this not quite so easy. And so whatever 2024 brings and beyond that, it's not going to be easy either. But the strategy that'll get you through remains the same. So you can either start trying to predict the future and likely, of course, fail, like almost everyone does who's in the prediction business, or you can just take whatever the market throws at you in stride and keep moving forward. That choice is always yours. At Investor Resources, we follow the trend. We follow the money. We track data and we keep things as simple as we can. That's really our investing style in a nutshell. And if you're looking for some help, we'd be happy to help you with yours. So will 2024 be an up year? We think it probably will. And if it isn't, it's going to be another opportunity to eventually prove the doubters wrong, because we think we're on the right track here. So happy investing to everyone in 2024. Happy New Year, and best of luck to all of us. I'm going to throw this back over to Don.
Thank you, Perry. That gives us a pretty good summary of where we have been. So the last two decades have given us two massive bear markets, and many investors are much further away from their retirement goals than they ever imagined was going to happen, because it turns out that compounding returns, compounding interest, doesn't directly apply to the stock market. It's basically a myth that you compound market returns. It's dangerous trying to invest for retirement with just the assumption that the math is always going to work. Bear markets matter, and they matter a lot more than people think. And there is some massive disruption that occurs as people put money into the market. And that is what this chart shows, that every time you turn around and think that things are going to get better, something else shows up. And one of the ways that people have adapted is to buy the dip. And we have on this chart the dip interventions. It's kind of become a conditioned Pavlovian response to the Fed stepping in to rescue the markets every time something begins to drop. When Mr. Market says valuations don't make any sense, as Perry just referred to this 22, the Fed turns around and the market turns around and says, well, Mr. Powell, aren't you going to do something about this? The market's supposed to go up, and you're letting it go down, as though he has a rheostat that adjusts where the market is headed, and that some days he's in a bad mood and that lasts a long time, and other days he's in a good mood and he turns the direction back up. And by the dip strategy was has been tried many times. Even when it wasn't working, people continued to believe that it would because I'm buying cheaper than it was, without understanding that cheaper now can be cheaper still going forward, undoing the benefit of that early buy. But 23, it began to work again. So optimism came back, and it became a reflexive bid into weakness. And so currently the Fed funds futures. So in the options market, people bet on what the Fed's going to do, trading futures on bond pricing. And they're basically, until this week, they were pricing in 6 rate cuts this year. It's been shaved back a little bit. The policy rates were projected to drop from the 5.5 range down to less than 4 by the year end. And the first one was supposed to be coming in March. That's now been pushed out to May, or even possibly a little later. But part of what the Fed's looking for is changes in the labor market. Unemployment is at, or near anyway, historic lows, and remains structurally tight with nearly 1.4 jobs available for every unemployed and insured person seeking work. Financial conditions of ease, that's certainly true. US equities are either at or well, let's say the indexes are at or approaching all-time highs. Across the broad sector of the spectrum of the market, that's not true. But it begs the question: will this be another policy misstep for Chairman Powell? The Fed blinked in late 2018. Now, it wasn't Powell in charge at the time; that was Janet Yellen, who's now head of the Treasury Department. But late in the 18, during the hiking cycle, apparently due to political pressure, the Fed took the position that inflation was transitory. Turned out that it wasn't. They finally buckled to the pressure, and we refer to this as politically motivated because inflation was transitory until President Biden reappointed Chairman Powell to another 4-year term as chairman. And within weeks of that appointment, all of a sudden, inflation was not transitory, but interest rates need to be higher for longer. It was an about face in just a matter of a few weeks. We've seen that again recently. So the real question is the Fed going to trigger another inflationary run? If we do get a slowing economy and the Fed steps in as they have over the last couple of decades, that can generate excitement and cause buying in anticipation that inflation is going to be higher, prices are going to be higher, let's get our buying done now. It becomes kind of a self-fulfilling deal. It's the same problem that under Chairman Burns back during the Reagan administration and Paul Volcker before that, they basically thought they had inflation whipped and then started easing and inflation resurrected, and they had to come in and actually it was Burns first and Volcker second. Mr. Volcker had to intervene with much higher rates again. Now, he didn't hit the highest rate of the prior cycle, but he created a massive recession in order to knock the legs out of the stool of inflation, which had been very elevated prices. And Mr. Powell has referenced a number of times that he doesn't want to repeat that mistake. But another catalyst for inflation could very well be the supply chains are slowing, which reduces inventory. And if there's still demand, then sellers get to based on that demand, they push prices up because they have more opportunity to sell a limited number of stuff. This is the supply demand cycle that you learned when you took basic economics. But on top of that, we have the problems of delivery time coming from the tensions in the Red Sea, and it hasn't been in the news that much, or certainly not paid attention to, but there's a drought in Central America, and it is damaging the ability for ships to get through the Panama Canal. So we're already seeing some signs of a structural bottleneck re-emerge. And if that's the case, then the stuff that's in the warehouses and on retail shelves that aren't locked up, that inventory is going to shrink for a while, which will most likely sustain prices and keep inflation pressing a little longer. So instead of higher, it'll be higher rates becomes higher for longer is now inflation. The assumption is that it's going to come down, and yet there's a lot of pressure here that is very likely to keep inflation much more persistent, restricting the ability of the Fed to cut rates early in the year. Some of the Federal Reserve Bank presidents are saying it's going to be late this year, possibly into 25. And if that's the case, then the current rate assumptions that the market is making are out of whack. And if rates then must respond by rising, that's going to put pressure on stock prices at the present time. There's a lopsided bullishness that is giving us a very tumultuous first week here in 24, with both bonds and stocks having the worst start to a year in more than 2 decades. We have to go back to the first year of 2000, the top of the tech bubble. It topped out in March of 2000 and didn't really start to decline until 2001, excuse me. But as we go into this year, we've had pretty stretched valuations in both areas. Perry just kind of covered those in his part of today's presentation. And so we ended up with an opportunity for profit taking, which normally occurs in returns of a decent year. December often sees profit taking, but when you have to assume that investors who had concentrated in the Magnificent Seven arena had substantial gains, and here we are at the end of December and they're having to say, well, these are really extended. What do I do now? Do I take my gain and pay tax in April? Or do I wait until January and pay tax in 2025? We believe that's more than likely. The typical year-end selling has occurred this January to give us what looks like a very rough start. It's more of a capital gains to tax decision than it is worried about an economic recovery or an economic growth rate continuing and fears of a significant recession diminishing. 23 was also a year where household cash and equivalents reached record highs. In fact, as my wife was reading the Epoch Times last night, and while I'm fixing dinner, she said, what are people doing if money's leaving the banks? Because here it says in this article, banks are losing their deposits, which they are. And she said, well, what are they doing with the money? I said, well, they've been putting it in higher paying money markets at their brokerage firm. They've been paying investing in higher paying CDs through their brokerage firm, or they've been buying short-term treasury securities at their investment firm. But all that's money is both leaving the banking system, which makes it more difficult for banks to make loans. And it's also money that is opted out of equity purchases for a fixed rate, let's just call it on average a 5% return. So much of this liquidity building is occurring within the top 20% of households, The bottom 50% are still basically struggling just to save money and try to build a cushion of capital because the inflation impact on household budgets remains real despite proclamations from the administration that inflation is not a problem in as they look at the numbers. So declining inflation, slowing rate of inflation is eventually a benefit, but it doesn't solve the problem of the household budgets. One of the other problems for inflation persisting longer than desired is that non-liquid asset prices are rising, and specifically real estate. Housing prices rose at the fastest pace in 40 years. They reached all-time highs despite the Fed, for the first time in its history, stating that there was a housing bubble and a reset would be coming. It has yet to come. The fact that these prices are continuing to rise puts upward pressure on inflation or the equivalent rent surveys. So to avoid actually dealing with the price of actual sales, there is a survey done by the government that asks what you think as a homeowner, what you think you could rent your house for. That's the owner's equivalent rent. And then they adjust that for what they think are anomalies, but it's still a rising number. The basic change in the marketplace is that there's a shortage of supply because people who have mortgages refinanced in the last couple of years, and let's just say that on average the mortgage rate's 4%. A lot of them were 2.5 or 3. A few got into the 4.5, but somewhere between 3.5 and 4%. You want to go out and even at the lower rates from the peak, recent peak, if you go from a 4% rate to a 6.5% rate, that's not attractive at all. So the people that have mortgages aren't going to sell unless they're highly motivated. Illness, can't take care of the house anymore because of age. We want to be closer to family, maybe due to age, maybe because we have our first experience with grandchildren and they're way across the country, and we don't want to be that far away in these early stages of what we've been waiting for years. So this area can continue to keep pressure on the Fed because the data they're relying on, 1/3 of the inflation factor comes out of this housing market. Here's existing home sales. So, but there is an increasing in supply, but it's coming on newer houses built by major national firms. And in many cases, they are building new communities where everybody rents. It becomes a cash flow item for them. So between the rise in housing prices and higher mortgage rates, we have a real slowdown in existing home sales, more so than anything we've seen since 2011. Much of this is, as I just said, was mortgage rate impact. People being locked in, and they don't want to downsize, which would be one option. Affordability, however, particularly for the next generations that should be family formation, children wanting a backyard, want to get out of the city because they don't want their kids playing in the street, security issues. I mean, it's at an all-time low. It's really hard to save enough money in early career wages with limited inventory, sustaining or pushing prices higher. It's just hard to get started on that. So there's going to be a delay in how this gets worked out. And in the long term, that means home builders actually have a very good couple of decades ahead of them, unless interest rates really fall and get back down to make affordability much easier to come by. But One of the things that comes up in the news is the haves and the have-nots. And if the U.S. land were divided like wealth is, 1% would own this part of the United States, 9% this part, 30% here, 20% would own the lower 2/3 of Texas, and 40% would own Houston, somewhere down there. I mean, that's most of the struggle isn't occurring with the people that have money, and that's obvious. You know, that was a great insight, wasn't it? The problem here is that as we look at the market, the question was, we've had these big run-ups, and whether or not the market is priced in an area to be able to move higher or not remains a significant question for us. This goes back and looks at the price earnings ratio at various market tops. So Perry mentioned the tech bubble back in 2000. March 24, 2000 was the absolute peak. And from there, it was 2.5 years down, but the PE was 25. The last time in 22, we were at 21. And now with this recent approaching highs, we're at 19.5. That's quite a bit lower than here. So yes, these prices in an absolute term are extended, but what has happened is that we've had improved earnings. And part of what we kind of expect to see in the next 6 weeks as the first earnings report comes in and how did businesses do last quarter. This may be a little dicey in this quarter, but we think as we move through the year, we're going to see that earnings continue to improve, which will allow this PE ratio to extend. There is room for more upside movement. On this is a daily chart, candlestick chart of the S&P ETF, the ticker's SPY, and the time segmented volume is following the index. That's this down here. And as long as this doesn't collapse, that's been, it's generally supportive. And all these green arrows basically are higher days of higher lows. You can see that since the end of October, this has been an accelerated run, and prices are ahead of what are expected earnings coming up this next quarter. So to see some sell off isn't a real surprise. Plus we have the tax issue that I just mentioned a moment ago. Since the 20th, volume has steadily declined, and the ETF has moved up anyway. It's so seeing a sideways development is actually a positive. There's two ways that the market actually corrects. One is the bear market. That's this kind of decline through here. And the other one is simply to move sideways and allow earnings to catch up with the speculation that causes this kind of accelerated rise. And that is healthy in that it sets the stage for another move higher. Now, COVID-19 wiped out the speculation in the NASDAQ, and it's recovered at a much slower pace. This is a detrended price oscillator down here, which basically is a tool to take a look at whether or not the money flowing in and flowing out is tracking with the price. But what I have here on the NASDAQ Composite Index is, as we look at 2020 and the tech bubble that started in 97, had this massive rise, the 2000 kind of flattening out, and then the realization that there's nothing, nobody had any reason to buy anything. Sales were collapsing, and they were going to continue to collapse, and until there was a major change in innovation in software and hardware. And it took almost 3 years for that to come about. This current run is not nearly as accelerated, exaggerated, isn't as deep, and we're trying to make new highs. The DPO tells us that there's room for this to move higher as we move into the next several years. Was that going to happen this year? Certainly, we have no idea that it will. But certainly as we move into 25 and 26 and beyond, with the innovation that's going on, starting with AI and its application to other areas of business, there's plenty of room for the NASDAQ itself to find new highs. Headlines focused on the Magnificent Seven, but the major benefits of artificial intelligence are going to be expanded application to other industries from retail, healthcare, shipping, manufacturing. And we have yet to figure out where these massive changes in productivity or businesses and households are going to be realized. And most of them are coming right now with companies that may not even be listed on the stock market. Stock market has a lot of new industries that we should be able to invest in. Some of these companies will have IPOs, initial public offerings, and they will expand. They will become competitive in niche areas of the economic world. This is a similar sea change as the introduction of the personal computer was, that knocked IBM's dominance in computers off its pedestal, when management did not understand the significance of the DOS system and the personal computer. IBM's position was, who needs a computer on their desk? I mean, that's dumb. Look at these big buildings we have. We have computers. Nobody's going to buy those. And today they don't. Major companies that take their current dominance for granted are at risk of being knocked off their pedestals by companies that may not even exist today. The rising inflation line here, I've put some arrows on both sides, this green line, so you don't get distracted by all the other ups and downs. That's really the issue right now that households are having to deal with, and they're indifferent to the declining rate of inflation that I mentioned a moment ago, because their households are still dealing with this issue. Consumer prices under the Biden presidency are up 17%. So some items may be lower than they were at the first of last year, but it's still 17% higher since the new administration has taken over. Gas prices are still up 28%. Credit card debt's up 40%. Real hourly wages are down almost 3%. And 30-year mortgages aren't 2.5 anymore. They're actually up in the higher 6s. They've been higher, but they've softened. And that's the president's trying to take credit for that, not acknowledging that this still is a negative for households and the economy. Now, economic growth is important, and largely our economy continues to be driven by consumer consumption. We are basically getting back on track after the government mandated disruption occurred. Markets will adjust, households will adjust, wages will adjust. This is going to work its way out. It's just that whenever government gets involved in trying to run the economy, things get messed up. Now, as Perry said, the Dow has reached new highs. And what I have here is a monthly chart. The Dow lacks much technology. There's only one tech company in the Dow. But when we look at the detrended price oscillator, what we see here is it clearly is not near its high. It has room to continue moving up, and the lower indicator here indicates that the volume of activity associated with Dow stocks is consistent with these price movements. So we are expecting to see more new all-time highs work their way through the system over the next couple of years, barring some black swan catalyst that you never know what happens until and you stumble and fall in the hole. But this particular index holds a lot of companies that are facing obsolescence. Artificial intelligence is attracting new capital. And the recent rate of change here, we can continue to move to new highs in the Dow, but it's unlikely that it's going to keep pace with the S&P 500 or the NASDAQ. So at the end of each of these presentations, we show you our macro tracking of the various major components or indexes. And here, when we wrapped up the week, our cash bogey basically tells us that commodities and the US dollar are the two asset classes that are having the most difficulty. Depending on your tolerance for volatility and your time horizon, all these other assets have some benefit to them, but generally not in the shorter term. They are all going through some sort of return struggle. When we look at the sectors represented here by the spider, 11 major sectors, plus we've added a couple. Gold is not a major spider. Biotech is a subsector of healthcare. But even these show signs of some difficulty recently. Energy has already had a ton of problems and is showing some signs of life, though there is clearly still some short-term risk. What's happened to help it lately has been the Houthis shooting at any ship that they don't like coming through the Red Sea. So last month, this was our allocation in our various portfolios. And just a reminder that risk is in the market and risk doesn't change with your fear of loss. Market risk is not a function of your wealth or your goals. Investors have common goals. It's grow my account and don't lose money. But they never seem to change their risk profile until some disaster occurs, and then they become more conservative, or until after an extended period of market growth, and then they decide they missed out and they should have been more aggressive. So they become aggressive at market tops and they become fearful at market bottoms. Here's where we are at the end of this week. We're fully invested. We hold very little cash other than Dynamic, which is doing some rotation. So at the end of the week, it has a 40% cash position, but that is not a permanent position. It may well be gone by the end of this next week. So we're not in the prediction business. We don't know exactly. Well, nobody knows where the market's going. I mean, it's a guess. It's a flip of the coin. We are in the interpretation business. We interpret the charts. We are trend followers. We do not know where the trend is going. What we do look at is the historic probability that trends have a tendency to persist. So we want to buy leadership that has an improving trend and stay with it as long as we can. Investing is not hard. It's just not easy. If you buy and hold or buy the dip, there's no certainty that you will reach your goal, because it can take as long as 2 decades to get back to even after a significant bear market. Markets are dynamic. They're changing all the time. People's opinions of investors about what's going to happen next change based on headlines, based on earnings reports, based on a Fed announcement or a speech from somebody they follow, a YouTube presentation. They change their mind. And if enough of them are changing their mind at one time, market prices change. So preserving your investment account is not for slackers. Somebody has to pay attention, and it's something you can do. If that's what you want to do, you pay for some software and you set up a disciplined trading decision process, and then you pay attention. And if you're not going to do that, you need to hire somebody to do it for you. If you can learn to do this, or you can hire us. That's an option. Perry, we have some questions to deal with. Let's go ahead and take those. And while Perry pulls that up and turns his microphone on, if you, some of you are not clients, if you want an opinion from us about what you hold and what we see going on with your assets, you can call us or send us an email. All we need is a list of your tickers. We don't need to see your statement. It's just a function of what do you own, and do we look at it and think that there's upside that justifies the existing downside risk? Because everything you own in the market has downside risk. The question is, what's the upside relative to that risk? So Perry, where do we go from here?
Okay, we've got some questions, as always, questions on the board. Rick would like to know if you decide to put your portfolios into cash, are you using money market accounts or 10-year treasuries, and how much cash would be allocated for different portfolios?
Well,
and we're not using, we can go to cash in all of our portfolios. The amount that goes into each one is always driven by market conditions. It's never a percentage that will max out. They can all be 100% cash. They can also all be no cash. That's always market driven, and so there's no way to know ahead of time. And for a long time, we were just putting the money in the bank at Schwab is our custodian, and it would just go to the Schwab bank because it's a temporary position, and it's not going to be there that long anyway. But when rates increased significantly, we started using a couple of places. We have a short-term corporate bond fund, FTSM. That's what we use to rank cash in our portfolios. And then we also use a fund, BIL, which is short-term treasury, 1 to 3 month T-bills. And both of those were, pushing 5%. And so it was time to use those. If we have a significant cash position that looks like it may last a bit, that's where it goes. It goes into those to the short-term fixed income. Anything else, if it's just a trading issue, that'll probably just sit in the Schwab bank. Of course, making near zero returns until it's reinvested.
Well, Schwab Bank isn't quite zero anymore, but it's close.
Right.
But you're right. Rick, I would caution you. One thing we would not use for cash is the 10-year, because now you're asking for duration risk. And typically, if you want cash in the account, it's to protect your capital. And if you go out 10 years, and rates rise, then your capital position that you're trying to preserve will be damaged. So taking a position in the 10-year treasury, or even more so in the 20 TLT or the 30 with Vanguard's, I think that's EDV, the longer you go to get a higher rate of return, the more downside risk you have if inflation persists and rates rise. So when we talk about going to cash, we would not be, the BIL is a 1 to 3 month T-bill. FTSM is corporate paper, and it will go out 60 days, but on average is somewhere less than a month. So when we talk about cash, we're talking about short-term, minimal fluctuation, decent interest rate payout every month, but we do not want duration risk. And anytime you move beyond 5 years, your duration risk is probably unacceptable if you're trying to dampen portfolio volatility. That's a good question.
You bet. Jim would like to know, is asking, the recent Dow highs aren't really all-time highs in monetary value. Inflation over the last 2 years has made money less valuable. Where's the Dow compared to the all-time highs, considering the last 2 years of inflation?
We don't have a chart for that, and
we don't.
I don't have. It's a valid concern.
Sure.
But the market doesn't work on inflation-adjusted numbers. So the only way we can track what's going on are the prices that we get today. Yeah, I don't know of a chart somewhere we would run across on maybe a podcast
Right.
or one of the um, information leads on the various subscriptions, but in all the stuff I've read on a regular basis over the last couple of weeks, I've not seen anybody put out inflation adjusted price charts for the indexes. So I
And you can
given
usually
it,
find somebody's take on inflation adjusted returns, but they're just like risk adjusted returns. It's more, it becomes a little bit of, well, inflation since when and over what time frame. So they vary a lot also.
so for portfolio managers often use risk adjusted returns,
Yeah.
and they say, well, our returns are lower than the index, but we had less risk. Okay. But then the client says, but you didn't keep track, you aren't tracking the index. And the manager says, well, yeah, but we had less risk. Well, yeah, but I want the return that the index has. So
Especially on the upside, right?
yeah, I don't, your risk adjusted returns fine in a bear market. I don't care about it on an up market. So it's a conundrum that just is one of the anomalies of our kind of business. I don't have an answer for Jim.
Okay, Dan would like to know, with a negative first week at the start of the year, what do you think's ahead for the rest of the year?
Well, Perry, you actually kind of touched on that.
We did touch on that a bit.
Yeah, and I ran across this the other day. Let me expand this screen here. I guess the easiest way is just to make it really big. So this is one of our subscription databases, which has a ton of information in it. But this basically takes a look at the years where the market ended more than 20% and what happened in the next year. And it doesn't always go up because there's a couple of negatives in here. We don't know what this will be going into 24. But what it says is that about 80% of the time, the next year is higher. I started to interrupt you when you were talking about this part, but you changed slides, so I kept my mic turned off. The point to remember is just because there's a big year here that was more than 20%, 4.5% is a positive year. 2.6 is a positive year that follows. So just because we had a year that's better than 20 in the index, you have to remember it was really created by just a few stocks. To assume that that same return is an extension of that rising line is a major error in portfolio construction, because you could end up with a flat line and go from 26 to 2.6. Just move the decimal to the left.
And that's the part that's always true. It's always true that nothing's going to follow suit exactly as the preceding year. So you can say the likelihood is we should have a good year, a positive year, but you never can tell, which is why diligence is always the key operative there. Okay, we're running a little bit long here, but let's get this last one in, just because it's a big question, seeing as it's about Apple, the largest company on the planet. Apple has been downgraded twice this week. Should I be worried about Apple?
Well, there's certainly reason to be so. So here's one of my charts on Apple. We'll bring this back up. So what are Apple's problems? They've had their two best new health watches taken off the domestic market because of patent or copyright infringements, and they were going to lose the lawsuit. So they had to quit selling them last month. And last year, Huawei brought out a competing smartphone, and the Chinese government told their bureaucracies, that's what you're going to use. And it just hammered the iPhone sales. And Huawei, initially we thought that was created by internal Chinese technology advancement. I learned just this last week that Huawei made that phone because they bought technology from a Netherlands company, a Dutch company. And this week, the US finally convinced the Netherlands to quit selling that technology to China. Be that as it may, both Barclays and Piper Sandler have downgraded Apple because of these reduced sales on high profit, high margin items. But let's take a more professional look here without regard to the sales issue. This bottom panel that shows very little gray at the present time is the percent of institutions. I'm sorry, I've got percent of shares held by insiders here. Insiders basically don't own Apple stock, and it's continuing to fall. Can Apple continue to rise? Yes, it can. This is the DPO I had on some other charts earlier, and so there is room for it to go up, but it has to be driven by the marketplace. Perry, I'm going to take 1 minute here. I thought I had PER percent held by institutions is what I thought I was getting. Let's take this one out of here. Here's percent held by institutions, which is 58%. And you can see that back here in 2020, that this was quite high. It was at 62%. But even institutions are reducing their exposure to Apple. Apple and many of the tech stocks are being sustained by retail hindsight investing. Amazon, here we are with a similar thing. We have room for it to grow, but institutions will not be the drivers. We're below 60%. If institutions are interested in the stock, this should be above 65. And we've just not been there. What do institutions do while this stock is rising through here? They're thinning their portfolios. They're looking further down the stream than retail investors do. That the story is similar where we go in other areas. Now here's Meta. Now Meta happens to be a new technology approach. Facebook kind of initiated their change when they said Zuckerberg changed from Facebook to Meta. He's actually introducing some new formats for technology that will be implemented elsewhere. But here, as far as the Facebook Meta platforms is concerned, that its growth potential is fairly limited. It's been around too long. It's too big to be extremely innovative. However, the institutions, while it's slightly lower, have not yet abandoned it. NVIDIA is benefiting from its introduction of the last major chip that allows for AI processing to work. It's a very expensive chip. I just had to rebuild my computer because the basement flooded and my computer was destroyed. And putting the graphics chip in it, fortunately, we were able to salvage because my IT guy said, these are really hard to come by. But look at here, we're down below 65%. There's been a real shrinkage in institutional ownership. Google, it's holding up fairly well, and it still has room to run. Tesla institutional ownership is below 50%. That number's 42 if you can't read it on your monitor. So we've seen this stock fall, and it is on the detrended price oscillator. It's actually got a negative number. The problem here happens to be Elon Musk. The institutions do not like him as CEO of Tesla. They think that obviously that the purchase of Twitter is very distracting. Plus, he has a lot of irons in the fire. And the last one, I think, was Microsoft. Microsoft is actually fairly strong. It's above 65, it's 69. And it's above, on the DPO, it's above its prior high. Microsoft is benefiting from their ChatGPT, their cloud business, and the fact that they just recently announced that they're going to make AI applications available in their platform of software. So some of these companies have some room to continue driving the index, but for the most part, retail investors are going to be doing hindsight investing here. What's actually happening is a major shift. I don't know if you've looked at our website of recent, but we just posted up the new Mona Lisa. Both of these are new this last week. But what's the new Mona Lisa? The Mona Lisa came about when obviously with Rembrandt and Rubens, and we had Michelangelo and the development of the Sistine Chapel. We had phenomenal building construction. The next major innovation, well, I don't know how they put those big buildings together without today's technology. In the 1850s, then we moved from the 1500s here to the 1800s, and we got the Industrial Revolution. And what we're getting right now is a change in technology where we basically refer to the 11 primary sectors in the market, but these are industry groups that are in the development stage because of AI. Who's going to be the winner? Nobody knows at this point, because a lot of the companies bringing these to market are really small. They're starved for capital. They have to convince big investors to take big bets to be able to bring these things to market. But these will become new sectors as we move into the next couple of decades here. So these companies that we just reviewed, they're 20 to 30 years old or more in some cases, and it's going to be a struggle for them to maintain leadership. Other than right now, retail investors will be pouring money into them because they've worked over the last 2 decades. Well, that's going to wind down. I mean, if we go back to the 1960s, I think at the beginning of the 70s, the biggest companies in the S&P 500 were all oil companies, and today they're less than 3% of the index. Anyway, Perry, that kind of covers my rabbit trail there for that question.
That clears the board. That was the last question on the board.
Okay, we thank you for watching, and check in on YouTube for our recent posts. If you haven't subscribed, do so. We'll be recording more in the next week. If you want to talk to us, there's our phone number. Email us, help@IRI-radio, and we wish you all a happy and prosperous new year.